Aloha from our Honolulu office, everybody. Welcome to Unraveling the Mystery of 1031 Exchanges in Hawaii. For those who've seen our presentation before, we're going to include some information specifically on Hawaiian real estate. And so as we go through that, we'll kind of make comments as it's applicable to Hawaii. Because we have a number of people on the call today, we're going to keep everyone in a listen-only mode. So go ahead and post questions in the question dialog box and we'll answer them. I'll try to take them as I go through the presentation. If I don't get to them, then I'll try to wrap it up at the very end, and we'll have time to hang out if you have more questions afterwards, so happy to chat. That's my QR code on the screen there for those who want to get a copy of the guide to 1031 exchanges, although that's also, I think, one of the handouts in the webinar, so you can download it through the webinar. And then it also has my personal contact information, etc., if you want that. And having said that, let's dive right in. So first of all, the company is Exeter 1031 Exchange Services. We are a qualified intermediary, or people refer to them as an accommodator, facilitator. Way back about 40 years ago when I got into business, they referred to us as straw people. Never was really fond of that particular title, but that kind of is what it is. And we're also an exchange accommodation title holder, which means we can hold legal title to real estate when it's necessary for a reverse 1031 exchange or for an improvement 1031 exchange transaction. So what it boils down to is we do all types of 1031 exchanges. Doesn't matter how basic or how complicated. We cover all 50 states. We cover the U.S. territories. We're also one of the few qualified intermediaries that will handle or administer foreign property transactions. That's one of the first areas where a lot of people, are unclear as to what the requirements are, because a lot of the things you see on the internet, a lot of the brochures and articles will tell you that you cannot do a 1031 exchange of foreign property. And that's not true. What they're really saying is you can't sell a foreign asset in 1031 exchange into a U.S. asset, and you can't sell a U.S. asset and exchange into a foreign asset. But if you're selling a foreign asset and that triggers a U.S. taxable gain, you can do a 1031 exchange of the foreign property as long as you're also exchanging for other foreign property. It can be the same country, it can be different countries, doesn't matter. But it does have to be foreign property for other foreign property, or on the U.S. side, you have to sell U.S. property and buy U.S. property. Back in the early 80s, you were able to actually do an exchange between U.S. property and foreign property and vice versa, but that was taken away from us because of all the abuse where people would actually sell U.S. property, exchange into a foreign country that has no tax treaty with the U.S., and it became a tax-free transaction. So today, it's just real estate for real estate. It's got to be U.S. for U.S. or foreign for foreign. Having said that, so like I said, we do all types of exchanges. That includes forward 1031 exchanges. Forward 1031 exchanges are where you're selling first and buying second. We do reverse 1031 exchanges, which is obviously reverse. You're buying first and then selling second. That sounds a lot easier, but it's actually more complicated. There's more expense involved. The reverse exchange, in a pure reverse exchange, you could actually go out, find your new property, close on it, own both at the same time, and then sell your current property. And unfortunately, the IRS does not allow that. So a pure reverse exchange does not exist. Would it be nice, but it's not. So we have this parking arrangement requirement where we, as the qualified intermediary, have to set up an LLC. In our case is what we use. That LLC becomes the buyer in your new target property. The purchase and sale agreement is assigned to that LLC. The LLC acts as the buyer and closes and receives legal title to the property. And then you have 180 days to sell your current property. So the beauty of a reverse 1031 exchange is you are able to go out, spend as much time as you want to find the new property, go under contract, negotiate, execute, open escrows, etc. And if you have to close first, you can actually close on the purchase. We take legal title to the property through that parking arrangement that I described. So that means you've actually tied up your new replacement property. You don't have to worry about whether you're going to find it, etc. You've got it, it's locked up, and we're holding title on your behalf. And then you have 180 days to sell your current property. So that parking arrangement creates all sorts of complexities. Lenders typically do not like them. There's other operational issues, et cetera, which we don't really have time to get into today. But having said that, it does take a lot of the risk out of the 1031 exchange because you don't have to worry about finding and identifying property during that 45-day period. So that's kind of a critical issue. But in our operation, and most of the competitors we talk to as well, I would say 96% of our transaction volume are forward 1031 exchanges. They're much more straightforward, much simpler, much less costly in terms of fees, et cetera. Only 4% are about or include reverse 1031 exchanges, with a very small sliver including the next one, which is improvement 1031 exchanges. So you can tell that there's a lot more involved there. You know, the lending issue is a problem. If you have an all cash position, you can certainly do that. It makes it a lot easier to do that, but they're more complicated. So that's why there's only about 4% of the volume is reverse 1031 exchanges. Improvement 1031 exchanges means that you're selling an asset, you're using the proceeds to go buy replacement property. And as part of that process, we acquire title, just like a reverse exchange. We park title to the new property. And then you've got the rest of your 180-day exchange period to use any excess funds to make improvements or retrofit the asset that you just acquired. So again, we do all of those types of transactions. The one that no one really talks about is the zero equity 1031 exchange. And the zero equity 1031 exchange really comes into play when you've got an asset, it goes up every year in value, you keep refinancing and pulling the equity out. All of a sudden we have a recession, the value drops considerably, and you now owe the bank more than what the property is worth. And a lot of times the investor thinks there's no gain to worry about because there's no equity, but that's not necessarily true. Equity is not the same as gain. So as an example, let's say years ago you bought the property for $100,000, and fast forward to today, it's gone up and up and up in value. Today it's worth $1 million. Every year or 2 years you've refinanced and pulled some of the equity out. So let's say it was worth $1 million, you did another refinance and you pulled out $900,000 total. So you've got $1 million asset with a $900,000 debt, and the recession hits, values drop. Let's say it drops to $600,000. So a lot of people think, well, I owe 900, it's only worth 600. It's underwater by 300,000. I don't have any equity. It's negative equity. Therefore, there's no gain. But that's not true, because you bought the property for $100,000. You've also depreciated that, so the cost basis is less than $100,000. It's worth $600, so you've got over $500,000 taxable gain. When you get into a recession, you might lose the property through a foreclosure, you might have to go through a short sale, a fire sale, you know, whatever it might be. And a lot of times people will say, well, I didn't worry about it because I don't have a gain, but actually they have no equity, but they could very well have a gain. And you could do a 1031 exchange on that, but there's no equity. So you have to kind of get creative, but it is possible. The 1031 exchange works like any other 1031 exchange. It is a regular 1031 exchange. There's just no equity. So having said that, you have to, have us set up the 1031 exchange. We assign the relinquished property sale contract to us, just like any other exchange. When the closing occurs, there is no equity, so we receive no cash into your 1031 exchange account. But then you've got 45 days to identify what you're going to buy. That's, the same as always. It's tough to find the property you want. Once you find that, you identify it. The tough part is, how do you buy it when you have no equity? So you either have to get creative, or you got to get out-of-pocket cash to make the down payment. You got to find creative financing, whatever it might be. So it is possible to do that. It just gets a lot more challenging because you have no equity. So those are kind of the 4 different types of 1031 exchanges. Really, there's forward, reverse, and improvement. A zero equity could be any of those categories. Again, the real property is the only asset that qualifies today for 1031 exchanges. Prior to 2018, you could do 1031 exchanges of any type of an asset, whether it was held for rental, investment, or business use. So we would do exchanges of shipping, trucking, aircraft, livestock, machinery, etc. Anything held as rental, investment, or used in a business would qualify. The 2017 Tax Act, which went into effect January 1st, 2018, took away all of the personal property. So anything that was not real estate no longer qualifies for 1031 exchange treatment. And then of course you could, like I mentioned, you could do exchanges of foreign property. So kind of a quick update there as well is when you're looking at 1031 exchanges, in terms of like-kind property, your U.S. territories, so Guam, the Marianas Islands, and the U.S. Virgin Islands are considered to be U.S. properties for 1031 exchange purposes. So those are domestic assets. Interestingly, Puerto Rico is not considered a like-kind property. It would be considered foreign property for 1031 exchange purposes. So anything that's foreign property would count. Anything that's U.S. property will count as long as you exchange foreign for foreign, U.S. for U.S. And just keep in mind those U.S. territories are a little different there, but you can certainly do that. We are actually one of the few qualified intermediaries that has any kind of regulatory or government oversight. So the first comment there is a lot of people assume that our industry is licensed and regulated and audited and et cetera. Our industry has no licensing or regulatory body or capabilities. So anybody can set up shop as a qualified intermediary. That's a scary thing. Qualified intermediaries hold a lot of money for a lot of clients, and there's a lot of trust there. So we wanted to be regulated, so we decided to go down the banking path, and we took a couple of years of going through the review and approval process to actually get licensed as a trust company. So in our case, we're one of the few qualified intermediaries that has any type of regulatory oversight. We're also one of the few that goes through not only the licensing process, we have the regulatory requirements like equity, capital, insurance, et cetera, and then we have to go through an annual audit. So we go through all of that process. So in our case, the actual qualified intermediaries, Exeter 1031 Exchange Services, it does all the administration, the paperwork, it actually works with the client and structures the 1031 exchange, but all of the cash and assets involved in a 1031 exchange are actually held in a qualified trust account, a separate, segregated, dual signature qualified trust account that's held by Exeter Trust Company, which is the licensed or regulated entity. So Exeter Trust is licensed, regulated, and audited by the Wyoming Division of Banking. We actually have an office on island, so we're on the Honolulu area. For those who want to stop by and visit with us, just give us a call. We can set up an appointment. We've administered exchanges for a long time. Personally, this is my 40th year doing 1031 exchanges. So we've got a long track record of doing 1031 exchanges. The Exeter 1031 Exchange Services has just entered its 20th anniversary. So we're really excited about that. 20 years has been a long time. We got there, we've done very well, and it's been a fun process. So we have a lot of expertise and decades of experience in 1031 exchanges. What does that mean to you? Well, in most cases, I think the most valuable thing a qualified intermediary can offer is advice, experience, examples, brainstorming, answering questions, things like that. So we try very hard to be more consultative and more advisory in nature by working with you and your advisors to get you to where you want to be, to get the right solution for you and what makes most sense. So backing up a little bit, Exeter Trust Company, like I mentioned, is our regulated entity. It's licensed, regulated, and audited by the Wyoming Division of Banking. A little more detail there. That means we have certain minimum regulatory requirements for equity capital, for various types of insurance and things like that. So we have a fidelity bond coverage. Fidelity bond is crime insurance. So misappropriation of funds, embezzlement, et cetera. If one of our team members were to steal the funds out of your 1031 exchange account, you're bonded. We have errors and omissions insurance, and that covers you in the event we make a mistake. So if we omit something, if we error in the documentation, anything like that, you'd be covered under the E&O insurance. And then because we're a financial institution, we also have a financial institution blanket bond coverage. So that covers all sorts of other things, including things like cyber fraud, wire fraud, et cetera, which are becoming more and more the risk in today's world. So that's really the benefit of what sets us apart is we're regulated, we're audited, so we have somebody looking over our shoulders. I'm going to talk more about that in a minute. We have the bonding that's really important, the minimum equity capital position, et cetera. The other thing Exeter Trust Company does for us is the ability to roll out other products. So we are actually offering other services besides 1031 exchanges, which include self-directed IRAs or 401k plans. Our specialty there is individuals who want to use their 401k or their IRA to invest in real estate, deeds of trust, mortgages, tax lien certificates, private non-traded entities, things like that. So most people call them non-traditional investments or alternative investments. And that all of that can be purchased as an investment inside your retirement account if you have the right IRA custodian. And that's our job. Exeter Trust Company is the bank. It is the IRA custodian and allows the investor to buy those non-traditional investments inside their IRA. We also serve as trustee for title holding trusts or land trusts for those individuals who want to negotiate, acquire, and hold the real estate in a confidential manner. We can do that through a land trust. In a lot of cases, when you've got either a sale or purchase of real estate after the fact, there might be some type of a cash holdback requirement. Maybe it's a toxic waste cleanup. Maybe there's construction or improvements or tenant improvements that have to be done first. All sorts of things. And at that point, once the real estate transaction is closed, there's no more real estate involved. There's no more deed that has to be insured or recorded. So a lot of title companies and escrow companies are not permitted to actually handle those type of escrows. We are under our trust charter. So anytime a title company or escrow company cannot do a certain type of escrow, we can certainly take a look at it and see if it makes sense. And we do a lot of those type of specialty holding escrows and also some specialty custody accounts when clients have special needs. Having said that, let's jump right into the 1031 exchange topic. So first of all, 1031 exchange is named after Section 1031 of the Internal Revenue Code. It has been around for now almost 103 years. The 103rd anniversary is this coming October. It's been around a very long time. It's a tax deferral strategy. A lot of people call it a tax-free exchange. It's really not tax-free. It is tax deferred. You can sell real estate, reinvest in other real estate, as long as it's all held for rental, investment, or business use. You defer the payment of your capital gain taxes, your depreciation recapture taxes. And because it's deferred, it does not trigger your Medicare surcharge or the 3.8% extra tax. So that's really the benefit, is it keeps it all deferred. It is recognized in all 50 states. Quick interesting note there, I know we're focused on Hawaii, but Pennsylvania was the only state that really did not recognize 1031 exchange services up until January 1st of last year. Now we have, they passed legislation where it actually does qualify. So 1031 exchanges now are recognized in all 50 states, including the state of Hawaii. The one thing I wanted to quickly point out is a 1033 exchange. This is an involuntary conversion or taking of real estate. And it really comes into play in two scenarios. One is eminent domain. That's where the government takes your property. Often they take it because they need the property for a school or a roadway or freeway egress, something like that. So they take the property. The other area where it comes into play is a natural disaster. So you have your property and it's destroyed by either fire, flood, hurricane, tornado, mudslide, etc. And you have a loss of the property. So either it's taken by the government or it's taken by a natural disaster. In those cases, it falls under Section 1033 of the code, where you can actually take those funds. So whether it be in eminent domain from the government or whether it's an insurance claim check from the insurance company, you could take those funds, you can reinvest them, and that's a 1033 exchange. In a natural disaster scenario, usually you file a claim, the insurance company issues you a check, and most people take that check and then they reinvest by repairing or rebuilding the property. They probably don't realize they have done a 1033 exchange, but it is. The insurance check, if you will, is considered sale proceeds in a sense, and then the reinvestment is by rebuilding and spending those funds. With an eminent domain, you get a little longer time frame. So with a natural disaster, you get about 2 years. Let's say it happens mid-year, you would get the rest of this year. You would get all of the next 2 years until December 31st of that following year. So you get about over 2 years, say 2.5 years at this point in time to reinvest. With a eminent domain, you get 3+ years. Now, with the 1033, it's not uncommon to have your attorney or tax advisor write to the local IRS office, the district office, and ask for an extension of time to 5 years. And it's actually very common to get that if you have a good story, a good reason, a good rationale as to why you need that deadline. One of the reasons I like to bring this up is with a 1033 exchange, you receive the cash proceeds, you don't necessarily have to reinvest the cash. As long as you buy or replace or rebuild your asset of equal or greater value, and whether it's done through cash or through new debt or a combination of that, it is tax deferred. So let's say you have an eminent domain scenario. They take your property, they take it and say it's worth $1 million. They give you a check for $1 million. You, in theory, could pocket that $1 million, not reinvest it. You could come over here and buy a new replacement property of similar or related in service or use, spend $1 million on it. If you can get 100% financing, great, and it would still be tax deferred. So it's a great way to pull cash out of your transaction, out of the property, and not have to pay tax, unlike a 1031 exchange where you would have to pay tax. The one downside is the definition of like kind is narrower. So especially in a natural disaster scenario, they really look at the terms similar or related in service or use. So if you were selling, sorry, not selling, but let's say it was a natural disaster, destroyed an apartment complex. If you took those funds and you went and bought vacant land, probably not going to qualify because the similar or related in service or use is not satisfied. Eminent domain, the definition of like kind is very similar to 1031 exchanges. Now, having said all that, if the individual taxpayer is in a position where they can actually sell the property through an eminent domain under contract to a government agency, and by doing that, they could also reinvest in replacement property within that 6-month window, they may want to structure it as a 1031 exchange instead of a 1033 exchange, so they can actually get a broader definition of like-kind property. That only works in an eminent domain scenario where you can actually go under contract and sell it to the government. Okay, having said that, we're going to dive right into the benefits now and then the mechanical kind of step-by-step process. So of course, the real benefit is you are selling real estate. It's going to trigger a taxable gain in almost every case. That is going to be taxable unless you do some kind of tax deferred or tax exclusion strategy. So when you're talking about real estate that's held for rental, investment, or business use, in most cases, people are going to look at a 1031 exchange transaction. So they sell real estate, they structure a 1031 exchange transaction, we help them document that, etc., and then they reinvest in other replacement property. And by doing that, it is all tax deferred. So it really keeps all of the money from the sale, the net proceeds or equity, in their pocket. Instead of having to write a check to the federal government and the state government for taxes, that money stays in their pocket, not literally in their pocket because it has to go into the 1031 exchange, but it stays under their control so they can have all of their cash available to reinvest in replacement property. It gives you a much easier way to trade up in value, buy more property, buy more units, increase your cash flow, etc. A lot of people ask us, well, what's the best way to take advantage of the 1031 exchange? When should you use it? Just as importantly, when should you not use it? And so those are really good questions. So my first comment there is always have your tax advisor review the transaction, because you may have something on your tax return that would make your decision differently. You might have net operating loss carry forwards that would offset any gain. You might have suspended passive activity losses. There's any number of things that may offset the gain, so where you could sell, trigger the gain, but still not pay taxes. We'll talk about partial exchanges toward the end of the program, but you might be able to do a partial exchange, trade down in value, and still not pay tax, depending upon your situation. So talk to your tax advisor, make sure you know exactly what you're looking at in terms of a tax consequence. Most investors will find that they've got a big enough gain, they do need to do a 1031 exchange. So then the question is, what's the best way to take advantage of it? And a lot of investors look at it as a transaction tool, which it certainly is. You're selling real estate, you're deferring the payment of taxes by doing a 1031 exchange. But it's more than that, it's much more than that. It's a wealth building tool. So you keep doing it over your lifetime. You keep exchanging. Every time you sell real estate that's rental, investment, or business use, you do another exchange. You defer the tax, you defer the tax. And then people will ask, well, you're just kicking the can down the road. I mean, at some point, you're gonna have to pay the tax. Not necessarily. So if you keep deferring it and then you defer it until you pass on and you leave the property to whoever inherits the property, and let's say your heirs are probably kids or grandkids, they could be friends, anybody. whoever inherits the property from you is going to get a step up in cost basis. So again, let's just say years ago you bought the property for $100,000. Today it's worth $1 million. You pass on, you leave it to your kids. Your kids are going to inherit the property. Their cost basis is going to be stepped up or increased from the $100,000 to $1 million, which is the current fair market value. So the kids start all over with a brand new, fresh cost basis. They start depreciating the property at $1 million. Or if they sold the property the next day for $1 million, their cost basis is $1 million. They pay zero tax. Now, if they hold the property for another 10 years, say, and the value goes up to $2 million, the heirs will be responsible for any gain above the $1 million adjusted cost basis. So that kind of gives you an idea. So really the best way is keep exchanging, hold it till you pass, leave it to whoever you care about. With a morbid sense of humor, we call that swap until you drop. So if you keep exchanging, you get that step up in cost basis, and then the gain goes away, the depreciation recapture goes away, you avoid the Medicare surcharge, everybody's happy. The reason you get that is because the value of the property that you're selling is going to be, or sorry, that your heirs inherit. So you do the exchange over and over. The end of the road, whatever property they inherit, the value of that property is going to be included inside of your estate for estate tax purposes. So they can't double tax you. They can't include it in an estate tax computation and also include it in a capital gain computation. So it's either or. So in most cases, it's going to be part of the estate plan computation for estate taxes. Most people will never pay estate taxes unless your value is quite a bit higher. Now, keep in mind in 2025, that's going to reset. So we'll have to see what happens there. But currently, the exemption per person is about 14 million. So you got a very large, very high estate. You might have an issue, but most people's estate values are much less than that. And because of that, because of the step up, and because it's a part of that estate plan, that's why you get that whole step up in cost basis, and you don't pay any capital gain taxes or depreciation recapture taxes. At the very beginning, I quickly talked about the different types of exchanges. So the forward exchange is what we're going to focus most on because that's 96% of the transaction volume. So that's your forward exchange. It could be concurrent or simultaneous, where you sell and buy on the exact same day. Very difficult to do today. There's too many moving parts, too many other parties. It's just hard to kind of get everything together. And the risk is if you've got everything scheduled to close concurrently, and then one of the parties has some type of an issue where the closing is going to be delayed, that could cause you some serious problems and have to backpedal quickly. So my recommendation is, close on the sale first, give yourself a week or two to, just in case there's a delay or there's a problem, so you've got time to fix it, and then close on the purchase. But most of these are delayed exchanges. You sell first, you close on the purchase later. We talked about the reverse exchange, take all the time you want, go out and find the right property, close on it. We take legal title to it through that parking arrangement I described, and then you've got 180 days to sell your current property. Especially in today's market where it's a tight market, low inventory, buyers are having a hard time with the higher interest rates, sellers don't want to sell and give up their low interest rates. All of those things kind of merge together and make it a very difficult real estate market. So with the reverse exchange, you can go out and spend all the time you want. There's no deadline up front. And then once you find your property and close on the purchase, then you go sell your current property, which in today's market's probably relatively easy. So that's why reverses have really skyrocketed. 3 years ago or so, it was only 2% or 2.5% of our transaction volume. And as I said, now it's about 4%. So it's almost doubled in volume. Then we talked about the improvement exchange where you sell an asset, use the cash to buy property. We hold title to the property again through that same parking arrangement, and you've got the rest of the time frame to actually make improvements to the property. Okay, the next couple slides are more of the mechanical steps, and it's also where there's the most confusion out there. These are the areas we get the most phone calls where they say, this is what I did, and it's like, oh, sorry, it's too late to do a 1031 exchange, and things like that. So we kind of want to walk through them. We get calls all the time where they say, I talked to 3 or 4 people, I got 3 or 4 different answers, and I'm really confused as to what really matters. That's why we name this Unraveling the Mystery of 1031 Exchanges. Our goal is to really tell you what the issues really are, what the requirements really are, And then you can make your own decision as to what's right for you. Some people like to be aggressive. Some people want to be very conservative. So you need to make a decision based on the correct knowledge, and then you can decide what to do. The real issue is when you're talking to different people, you're really getting opinions, and it sounds like fact. And that's why it's confusing, because one person will say this, the other person says that. They're probably both right, but they're just opinions, and it's not necessarily either one is right or wrong. They're just different approaches. So I'm going to explain that as we go through, and then you'll know what the issues are, and then you can decide what's right for you. First off, you need a 1031 exchange set up before closing. That is critical. Unfortunately, we get calls literally every week where somebody says, I closed yesterday, last week, last month, and I just found out about it, or I just decided to do a 1031 exchange. Unfortunately, it's too late. The reason for that is when you set up the 1031 exchange, the purchase and sale agreement is assigned to the qualified intermediary. The qualified intermediary steps into the investor's shoes as the buyer, or sorry, in this case, as the seller, and that's what allows you to defer the taxable gain. If you don't set the 1031 exchange up in advance and the closing occurs, the investor has the right to receive the funds, and that creates the taxable event. Even if they tell the closing agent, don't disperse the money, I'm going to do a 1031 exchange, doesn't matter. The closing has occurred, they have the right to receive the funds. That's what triggers the gain. So even if they tell them don't disperse the money, it is still taxable. They can't undo it, they can't unring the bell, so to speak. It just becomes a taxable event. So make sure you've got your 1031 exchange and qualified intermediary in place prior to closing. The qualified intermediary really does three things: drafts the documents to help structure the 1031 exchange itself, number one. Number two, if it's a forward exchange, we are going to receive, hold, and safeguard the 1031 exchange. And in our case, it's going to be with Exeter Trust, the regulated entity. Or if it's a reverse 1031 exchange, we're going to receive legal title to the property. Same as an improvement exchange, we'll receive legal title to the property, and we'll hold or park legal title until you wrap up your reverse or your improvement exchange transaction. And the third one I've mentioned, but I think I can't overemphasize it enough. It's really critical. 1031 exchanges are complicated. They should be simple. They are not. Over the years, there have been changes in legislation, tax codes, regulations, rulings, decisions from courts, all sorts of things that has made this really complicated. So our goal is to be consultative, be advisory, jump on a phone call with you and your advisors, walk through the challenges, whatever it might be, brainstorm strategies, make suggestions based on what we've seen other advisors do, and really help you get through or navigate all these complex issues. So having said that, how do you choose a qualified intermediary? And there's certainly lots of things to look at. These, in my opinion, are the three most important. And people overlook a lot of these things. They just don't talk about it. But I think it's important. I think it's critical that you understand what you need to look for when you're looking at a qualified intermediary. So some of this is going to get a little deep, a little technical, but I want to make sure you understand why. So the first one is government oversight is critical. I've been doing this now for 40 years. All the qualified intermediaries I have seen fail over the years would have been prevented had there been government oversight. In most cases, they're investing funds in a way that they should not invest, or in some cases, they're just flat out stealing. And if they have an annual audit by a government agency, things like that get caught. Our industry, again, has no regulatory authority or body or capability, so that's what's scary to me. That's why we went down that regulatory path. So you really need to work with a qualified intermediary that has direct regulatory oversight of the specific qualified intermediary. So they're getting audited. They have regulatory requirements. And if they fail to meet that, if they fail to operate in a safe and sound manner, then there's consequences. So to bring that home, actually, let me postpone that comment until the last item. So make sure they have regulatory oversight. That way you're protected. Number two, stuff happens, as they say. So you want to make sure that there is insurance and bonding and coverage of your transaction. Now, a lot of people focus on the fidelity bond coverage because it's crime insurance, et cetera. That's what you hear about. That's what hits the news, the TV, et cetera. But in most cases, a lot of the losses are not fidelity losses. They're errors and omissions losses. We do a lot of expert witness work, and most of those expert witness cases stem from a qualified intermediary that's made a mistake, or maybe another entity has made a mistake. Wasn't on purpose, wasn't theft, wasn't embezzlement, misappropriation of funds. They just made a mistake. So you want to make sure that you've got the right insurance. So I think the most important insurance is errors and omissions insurance. That covers you if the QI makes an error, omits something, screws up the documentation, whatever that might be. It actually covers you because of the error or omission. That's the most important because we're human and stuff happens. Second, there are going to be employees occasionally that do misappropriate funds. You do want to make sure there's fidelity bond coverage. In today's world, the biggest risk now is not necessarily human error, it's cyber fraud, wire fraud, and things like that. The hackers are getting extremely sophisticated. They're beginning to use AI, artificial intelligence, and it's amazing what they're doing with this stuff. So you need to be very careful. So in our case, we have a financial institution blanket bond, which does include cyber fraud and wire fraud and things like that, which is critical because there's always somebody out there that's smarter than you. So we have to face the facts that you got to be protected. You've got to be careful, but you also have to have the insurance coverage so that if somebody gets you at some point, you're covered and it's not a problem. Next area is qualified trust accounts. This gets confusing. People have a hard time understanding it. They don't understand why. So let me give you an example. 2008, one of the big five companies was Land America. They were one of the largest title insurance companies, escrow insurance companies, or escrow companies, and also a 1031 exchange qualified intermediary. It was their exchange division or exchange company that was investing the funds in auction rate securities. That is not a prudent investment for 1031 exchange funds or escrow funds or title funds. It's not a bad investment, but it's not prudent for 1031 exchange treatment. In this case, 2008 recession hit, the auction rate securities market froze. They could not get the investments back out. They had to start using incoming client funds to pay outgoing client funds. Then it got worse, fewer transactions, no more money coming in. They put corporate money into the into the fiduciary accounts to cover the outflow of client funds, and they ran out of corporate funds. So ended up in bankruptcy. And the judge ruled the funds were not client funds, they were corporate funds because they were held in a corporate name. Now, holding the funds in a corporate name qualifies for 1031 exchange treatment. But if something goes wrong, like it did in this case, they are not client funds, they're corporate funds. And the bankruptcy judge ruled that they are subject to the creditor claims in bankruptcy. That's the scary part. So if he also ruled that if the funds were held in a qualified trust account or a qualified escrow account, his ruling would have been completely different and they would have been client funds. So it's important that your funds are held in either a qualified trust account or a qualified escrow account. He seemed to lean toward qualified trust account in his ruling or opinion. So we went with the qualified trust account, and Exeter Trust Company is trustee of that qualified trust account. Okay, next slide. This is probably the most important slide out there. It's also the one where there's the most confusion and what have you. And again, we get questions and say, I've talked to 3 or 4 people, I've gotten 3 or 4 different answers, and I just don't understand what really matters. And where it really comes down to is people get hung up on the length of time they've held title or haven't held title to property. And we'll get people who say, well, I was told that I don't qualify for a 1031 exchange because I didn't hold the property for at least a year and a day, a year and a half, 2 years. And the question is, well, what really matters? So the issue there is no holding period. The tax code, the regulations, the rulings have no holding period required at all. What they do say is you have to have the intent to hold for rental, investment, or business use. That's the critical part. Well, how do you prove intent? That gets confusing sometimes. So that's why people get hung up on the length of time. You know, obviously, if you've held property for 2 years, that straddles 3 tax periods. Very solid proof that your intent was to hold for rental purposes or investment or business use. If you held it for 1 month, did you really intend to hold it for rental property? Maybe. It doesn't mean it's an automatic no, but a lot of people think that's an automatic no. Those are just opinions. What it boils down to is if you get audited, can you argue and demonstrate that you did in fact have the intent to hold for rental, investment, or business use? That's the bottom line. So here's a couple of court cases. 2 court cases, 2 developers bought dirt. intended to build single-family homes on them, and then sell like developers typically do. In these cases, they're totally unrelated, but neither one built anything. One held the dirt for 12 years, one held the dirt for 20 years. In both cases, they sold the dirt, did 1031 exchanges, both got audited, and both were disqualified. And it shocked everybody because those are long-term holding periods. And people always thought if you held it for more than 2 years, you're okay. It's not the 2-year requirement, it's the intent. So in these two cases, the developer's intent was to buy, build, and sell. It's held for sale, it wasn't held for investment. Now, in both cases, had they bought and built, if they had bought and held and then said, you know what, the real estate market has changed, my business model has changed. COVID-19 changed a lot of things for a lot of people. So something changed. I'm going to hold this for capital appreciation now, not for development. And had they changed the way they document the property on tax returns, loan applications, financial statements, emails between them and their advisors, things like that could have easily documented that their intent has changed, which is perfectly okay, and would show that their intent now is held for capital appreciation and then sell once it reaches a certain price point. So had they documented everything like that, their exchanges would have qualified. On the flip side, we had one of our clients who actually sold, did an exchange, bought a small condo, didn't read the CC&Rs until after closing, quickly found out within a day or two that it had to be owner occupied, not held for rental. Rental was not permitted. Immediately sold, did another exchange, and then bought another property they could rent out. As luck would have it, he was audited by the California Franchise Tax Board. They actually allowed his exchange to qualify because he could prove his intent was to hold for investment or rental, but there was a business reason why he couldn't do that. So as long as you can prove intent, it qualifies. Now, I wouldn't push your luck. I wouldn't hold it for a month and say, oh, look, I could do this because my intent is to hold for rental. That raises questions in the eye of an auditor. So be careful, don't do that on purpose. But when it happens, that's what it boils down to. The other area is qualified use. What's the property actually being used for? And so we go back to intent. Is it intended to hold for rental investment, or is intended to hold for sale? And that's really the key. Examples. So investors who are in the business of buying property and doing something to the property. It could be rehabbing, fixing up, or flipping, rehabbers, flippers. Could be builders, developers, contractors who buy, build, and sell. Could be condo conversion specialists who buy, convert to condos and sell. All of those are buying with the intent to do something and then sell the property. So they're holding for sale, they're not holding for an investment. It's kind of like inventory in a retail business. You buy it, you put it out for sale. Now, if they were to buy the properties, do something to the property, and then hold it as rental, investment, or business use, and can prove that, it would qualify. So it all boils down to what the use is. So that kind of gives you a quick idea on what the issues are there. So when people talk about the holding period or the holding requirement, there is none, but it's the intent that matters. The longer you hold the property, the easier it is to prove intent. So when I get those questions, what I typically say is, well, if you're selling rental property, you're buying rental property, and it's a straightforward, plain vanilla 1031 exchange, you're not pushing the envelope, you're not taking risks, 1 year is probably sufficient. It straddles 2 tax periods, plenty of proof, you got a lease agreement, 12 months of rental deposits, etc. If you're going to take any risks, if you're pushing the envelope, if something may or may not qualify, I'd rent for maybe 24 months. 24 months will straddle 3 tax periods. A lot more proof that that was your intent to convert it. So it depends on your situation, depends on how aggressive or conservative you want to be. Okay, having said that, the next area we want to look at is like-kind property. Still lots of misinformation out there about like-kind property. There's still a lot of curriculum out there that will literally say if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments, etc. That is not true, absolutely not true. Like-kind means literally you are selling real estate, you have to buy real estate. It's as simple as that. So as long as you're selling real estate and you're buying real estate, and it's held for rental, investment, or business use, like we've already talked about, then it qualifies for 1031 exchange treatment. So like kind is a very broad definition. Anything that is considered real estate will qualify. So as I mentioned at the very beginning, the only requirement is you have to exchange US for US property or foreign for foreign property. Other than that, it will qualify as real estate for real estate. Personal property, meaning non-real estate, no longer qualifies after 2017. So this is a quick list of like-kind property. All of these are considered like-kind to each other. You'll notice that it includes things like air rights, water rights, mineral rights, certain types of oil and gas investments, fractional ownership, whether you buy a 10% undivided tenant in common interest, or if you buy a 1% interest in a Delaware statutory trust, all of those qualify as the purchase of real estate or the sale of real estate for 1031 exchange purposes. So as you can see, it's a very broad definition of what is like-kind property. For Hawaii, what we're seeing is a huge trend where you're selling property on the Hawaiian Islands, and the question is, what are you going to buy? The islands have experienced huge increases in market value. They've got a huge capital gain sitting there. If they sell and then buy across island or buy on a different island, what have you really done? So a lot of the investors are selling the property on island, and then they're reinvesting on the mainland, and they're trying to play arbitrage where they're selling at a very high market in Hawaii and buying somewhere else in the US where it's not as crazy, the cash flow pencils out better, etc. We're seeing a lot of folks who are going, well, I don't want to manage property that far away. So they're looking at the tenant in common investment properties or the Delaware statutory trust. And by far, the Delaware statutory trust is the most common asset that they buy out there to do that. So when you're on island, you're selling property there, those are things to look at if you want to do something different and get a better value, better cash flow, rather than just exchanging across the island. Keep in mind that the 1031 exchange really has to put you in a better position. Only you can define what that better position is, whether it's a better quality property or diversifying a bunch of properties, or buying a Class A property after you sold a Class C property, or diversifying by geographic area. There's lots of reasons people do exchanges, so you have to decide what is right for you and what would put you in a better position. If it's not going to put you in a better position, you probably shouldn't be doing it. Okay, just as important as what is like-kind property, we need to talk about what is not like-kind property. So anything with personal use typically is not like-kind property. So you've got your primary residence, you've got second homes and vacation homes and things like that. Anything with excessive personal use is probably not going to qualify. Now there's a huge gray area here. We get questions like, well, what if I rent it for 2 weeks or 4 weeks and I don't use it personally? What if I rent it for 10 months and I use it personally for a whole month? What if I use it personally for 10 months and I rent it for 1 month? There's all sorts of combinations there. And the issue is it depends. If you get audited, you have to demonstrate that it truly is held for some type of rental, investment, or business use. If under audit, they determine it's really for personal use, it's a primary residence, a second home, or vacation property for personal use or for family use, it's probably going to be disqualified. So that's really the issue, is anything with personal use is not going to qualify. This area gets really complicated, so we're just going to kind of touch upon it, and then, if you have questions along this line, I'm happy to chat with you after the fact. Investors that own real estate inside of an entity have to be careful, because the investors do not own real estate. The entity owns real estate. So probably the most common example in today's world is an LLC. 2, 3, 4, 5 people get together. They want to invest and buy property together. They set up an LLC. They all put money into the LLC. They become members of the LLC. That is treated as a partnership for tax purposes. You have a multiple member LLC, and that defaults to a partnership for tax purposes. That entity is a separate entity. It's not disregarded. It's a separate legal entity. So when it goes to buy real estate, it's buying it in its legal entity name. Later, when you go to sell, the legal entity is selling the real estate, not the individuals. So if they don't do anything, then the individuals are just getting cash distributions, and that does not qualify for 1031 exchange treatment. So a couple of thoughts here. Number one, if the entity is going to stay together, all the investors want to stay together. The entity sells, the entity does a 1031 exchange, the entity buys replacement property. Very clean, very plain vanilla. Any type of entity can do a 1031 exchange transaction. Where it gets complicated is where the underlying members or investors or partners want to break up and go separate directions. Oh, they're just getting cash distributions. So there's all sorts of potential solutions there. So we have to look at the facts and circumstances. We have to look at the goals and objectives of each of the members, and then try to figure out what is the best structure for them. So we all jump on a conference call with their tax and legal advisors and kind of walk through the options and find the best solution possible. So anytime you have a corporation, whether it's an S Corp or C Corp, partnership or limited partnership, or an LLC treated as a partnership, that's the issue. It's not owned by the individuals. The real estate's owned by the entity. Now there's exceptions to that. So if you have a living trust is a pass-through entity, which means everything passes through to the individual's tax return. It is also a disregarded entity. It's treated as if it does not exist for tax purposes. So let me put that thought on hold. So that's one exception. I'll explain that in a minute. Second exception is a single member LLC. Single member LLC has one member, as long as it's the same member that's doing the exchange, and it's considered a disregarded entity for tax purposes. That means it exists from a legal perspective. It gives you the liability protection you're looking for, but it does not exist for tax purposes. You do not file a separate federal income tax return for that disregarded entity. So in both cases, you could sell from an entity and buy as an individual. Let me give you an example. Probably one of the most common is you own some type of rental property. Let's say it's an apartment complex. It's owned in an LLC. The LLC is a single member LLC. You are the single member. It's disregarded for tax purposes. So for tax purposes, you do not file a federal income tax return. You sell that, you do a 1031 exchange, you go to buy replacement property, and the lender says, nope, I will not finance in the LLC. You have to take title as an individual. Well, usually right off the bat, people panic and say, oh my gosh. And the reason they panic is out there on the internet, on articles, brochures, etc., people will tell you that legal title on both the sale and the purchase have to be held in the exact same legal name. That is not true. That's the easiest way to explain it, but it is not completely true. It has to be the same taxpayer. That's the critical issue. So you sell as an LLC, it's a single member LLC, disregarded entity, you go to buy, lender says no. In that case, because it's disregarded, you could buy it in your individual name, and then immediately after that, deed it into the LLC. Because it's a disregarded entity, it's still treated as if you own the property on both sides in your individual name. So that works. Same for a living trust, same exact issue. Delaware statutory trust, land trust, all of those are disregarded entities as well. So if it's disregarded, there are exceptions. If it's not disregarded, C Corp, S Corp, partnership, limited partnership, LLC partnership, it's a whole different ballgame. So one of the things you can look at today is, what is your exit strategy? What do you think it's going to be? If it's a multiple member LLC, do you think you guys are going to stay together? Do you think you guys are going to break up and go separate directions? Talk to your legal and tax advisors today. Find out if you're holding title the best way possible so you're ready for whatever your exit strategy is. There's all sorts of solutions. You know, in the partnership area, the easiest solution is what they call a drop and swap. Drop and swap means you deed the property out of the LLC, you take title as individuals, you are now treated as tenants in common, individual ownership. When you sell, you can each do your own thing. The problem is if you drop it out, immediately sell, there's a risk. Did the individual intend to take title specifically to hold for investment, or did they take title just to buy, sell, and do a 1031 exchange? Under audit, they could very easily be disqualified because their intent was not to hold it, but was to hold it for sale. But if you've got 2-year window or more, you could certainly drop it out of the LLC today, take title as individuals, as tenants in common, season it for 2 years, because now you got a 2-year holding period that will straddle 3 tax periods. Very solid proof that was your intent. Then when you sell, you can each decide what you want to do. So that would be one way to do it too, but you need a 2-year window to kind of do that. Okay, for the next area, so this is very specific to Hawaii, and this is, we have FERPTA issues and we have HARPTA issues. First one we're going to talk about is FERPTA, so that applies to all 50 states, but you see a lot of this in Hawaii specifically. FERPTA covers the sale of US real estate that is being sold by a foreign person. And we don't have time to define all that because there's all sorts of subcategories. But if a foreign person is selling real estate in the US, in a lot of cases, there's going to be federal withholding requirements. Generally, it's a 15% withholding. There are exceptions. It used to be that it was relatively easy to apply to the Treasury or the IRS, request a certificate of exemption. The closing agent will get the certificate and there'd be no withholding. They've changed that entire process now. So first you have to obtain your I-10 number if you don't have one already. Then you have to apply for the certificate of exemption. And there is no, well, I shouldn't say no way, but 99.9% of the time you are not going to get the certificate in time. So there is likely going to have to be withholding. So the closing agent will withhold that 15%. What do you do? Well, there's a couple of options. The best case scenario is, you know there's going to be 15% withholding, plan on it. Worst case scenario, plan on it. It's probably going to happen. If you can, put that 15% dollar amount out of your own pocket into closing. You are literally paying for the withholding out of your pocket. You're funding the withholding. That way, the sale transaction has 100% proceeds, cash proceeds, going into the 1031 exchange. It's all tax deferred. The downside of the negative is, if there's going to be with 15% withholding and you can't put money into the closing, and they're not going to get that certificate of exemption in time, which is highly likely, then you're going to have 15% withheld. And if you can't reinvest that 15% in the new replacement property, that's going to be considered taxable. So that dollar amount representing the 15% withholding becomes a taxable item. You pay tax on it. So that's really the issue. There's all sorts of ways of working around that, et cetera, but it does get complicated. There are attorneys that do nothing but FERPTA issues. So we'd be happy to refer you to some of those if you have those kind of issues that you got to work with. But that's FERPTA at the federal level. You also have HARPTA, which is your local Hawaiian withholding requirement. So if the sale of Hawaiian real estate is being conducted by a non-resident person, so really anybody on the mainland or anybody who's a foreign person, they're going to be subject to HARPTA withholding for Hawaii. Now, there's just like a lot of the other states, California has that, a few other states have that as well. There are exemptions for that. So in the Hawaiian Islands, you can file the form N289. That's your certificate of exemption request. Once they approve that, there is no withholding. So it's just a matter of going through that process well in advance, getting that done so there's no withholding to worry about. So Hawaii at a state level is fairly easy to work with. Federal level is very difficult to work with. Okay, having said that, let's go into the 45-day and 180-day exchange periods. You've got 45 calendar days from the close of the sale of your property, or if it's a reverse exchange, from the close of the purchase of your property, to identify what your properties are going to be. So in a forward exchange, you're identifying the properties you're going to acquire. In a reverse exchange, you're identifying the properties that you're going to sell. So the sale in a reverse exchange is not that difficult. Most people know exactly what it's going to be. In a forward exchange, you have to go out and find them, and that's the risk. With the forward exchange, the real risk is you're selling property, it triggers your gain. The question is, can you find property, identify the property, and close on the buy within that 180-day window? And if you can't, the exchange fails, it becomes taxable. There's no way to go back and fix it. That's one of the reasons the reverse takes all that risk out of it, because you've got the property locked up. But having said that, most people do the forward exchanges. You've got 45 calendar days to identify the replacement property. We'll talk about how to identify in a minute. There's no way to get an extension of time unless there's a natural disaster that involves you. So fire, flood, hurricane, whatever. The president of the United States has to declare that area as a disaster area, disaster zone. And specifically, you have to qualify under whatever that ruling is. And if you do, typically you're going to get an extension of time. The extension historically used to be an extension of 120 days. The last, say, 3-4 years with COVID and everything else, the extensions have been all over the place. So it's really difficult today to figure out exactly what extension you're getting, especially if there's 3 or 4 notices all in the same year. Having said that, a lot of folks are worried in today's market. Again, you've got high interest rates for the buyers to qualify with. You've got low interest rates that make sellers not want to sell. You've got low inventory because of all of that. So finding the replacement property is very difficult. So some ideas here. On the sales side, in a lot of cases, it's still a seller's market. So you may want to just post and say, look, buyers, you have to cooperate with me. I'm trying to do a 1031 exchange. I need a long-term closing, long-term escrow, or maybe I need options to extend, maybe 2 or 3 30-day options to extend. If the buyer says, look, I need to get into the property right now, maybe you offer to lease it to them with an option to buy. So there's different ways where you can tie up the buyer, make both parties happy, but not close until you're ready to close and start your deadline. On the buy side, same thing. If you can go and find property you like, if the seller's willing to cooperate, get a long-term closing, options to extend, offer to lease the property with an option to buy, things like that. There are ways you could do that where you tie up the property, control it until you're ready to close on it. So those are just kind of things to look at. Also, we mentioned Delaware Statutory Trust briefly. The Delaware Statutory Trust can be a great backup identification property. So if you say, look, I want to go out and find my own property, I'm going to do this and this and this, these are my goals, the third property you identify could be a DST, which could save you in the event the other properties are not accessible, can't be purchased for whatever reason, etc. So we'll talk about that more in a minute. After the 45 days, you have an additional 135 days to actually close on your purchase. So it's 45 days to identify, an additional 135 days for a total of 180 days to do the entire process. So be careful, it's not 45 plus 180, it's a total of 180 days. The one exception is if you're closing on your sale after October 17th, your 180th day lands after April 15th. So the due dates shrink because you got to file your tax return. Very easy. If you need more time, you work around that. You file an extension of time for your tax return, finish your 1031 exchange, and then file your tax return. You'll never have more than 180 days, but at least you'll get the full 180 days. Okay. Identification requirements, and this also can get complicated, but most people use the 3 property rule. You identify 3 properties. The real intent for 3 properties is you probably have the intent to buy 1. The second and third are intended as backup properties, just in case the one you really want falls out of escrow and can't be acquired. In today's market, it doesn't work so well because the second and third properties are probably long gone. But that's really the issue, is you can identify up to 3 properties, any value, doesn't matter what the value is, and you could buy all 3 if you wanted to, but most people identify 3 with the intent to buy 1. Some people are trying to diversify. They sell a large asset and they want to buy a bunch of smaller assets. So in this case, you might look at the 200% rule. So a specific example, we had a client of ours sell in California. They sold a $4 million asset. His goal was to buy a whole bunch of single families and diversify his risk, and he wanted to go outside of the California location. So in his case, $4 million sale price, he used the 200% of fair market value limit. In that case, $4 million sale price, 200% is $8 million. He can identify as many properties as he wants, up to $8 million in total value. In his case, he went to Tennessee. He identified 56 different single family properties. I can't remember, he bought 26 or something like that. So it just shows you that he could identify 56, as long as it's not more than 3 or more than 200% in that case, so more than 200% of the fair market value, he qualifies. You don't have to buy all of those. In his case, you just have to reinvest about $4 million or greater, but it gives you more assets to look at, perform due diligence, etc. So he ended up buying 20 some properties in Tennessee. That's a lot of single family properties to manage, but it is a good diversification for sure. The 95% exception, you have to be very careful with that. It's not that common. To me, it's really designed for a portfolio acquisition. So if you're, well, I'll use an example. We had a lady who recently identified 40 properties. We called her and said, look, it's more than 3 properties and the total value is more than 200% of what you sold. And she stopped us and said, don't worry, it's one contract, one seller, one buyer, one closing. I'm either buying all 40 or I'm buying 0. So in that case, she closed on all of them, which means she purchased and closed on 100%. That would fall under the 95% exception. She closed on at least 95%, so she's still okay. The identification needs to be very specific. It cannot be ambiguous. For example, if you're going to identify, let's say a condo, would be a good example. You have to use the condo address or the unit number, whatever it is, so they know exactly which condo you're going to buy. You can't just identify the property or the complex. It has to be the specific asset that you're going to acquire. And you should make that identification to the qualified intermediary. So that's really critical. The code says you got to identify to a party involved in the 1031 exchange. There are people who say, well, the broker's involved, the escrow company's involved, etc. To me, the people involved are the people who are in the 1031 exchange agreement, and that is the qualified intermediary, the trustee of the qualified trust account, and the client. So identify to one of those 3 parties, you are absolutely safe. The other parties may qualify, but the IRS ever comes out and defines specifically what that means, but we may have some challenges. Another area we get a lot of questions on is reinvestment requirement. How much do I have to reinvest in order to qualify for full tax deferred exchange treatment? So let's just use simple numbers. Let's say you sell a property for $1 million. The question is, what do you have to reinvest? Let's say it's got $400,000 of equity, $600,000 of debt. A lot of people think it's the equity or it's your taxable gain, your cash position. None of that is true. It's the top level. You're selling for $1 million. You are allowed to subtract your routine selling expenses. So your title and escrow fees, your broker's commission, the documentary transfer tax, recording fees, things like that. That is going to get you to a net sale price. Notice we did not subtract mortgage. Whatever your loan balance is not subtracted. So you just subtract your routine selling expenses. That gets you your net sale price. So on a $1 million sale, your net sale price is going to be about $950. As long as you buy 1 or more properties with a total purchase price equal or greater than $950, you've met the top line requirement. The government's really taken a position that you own this property and it's worth a net of about $950. And as long as you remain fully invested at that $950 level, you've deferred all your taxes. The second requirement is all the cash that comes out of your sale has to be reinvested. So all of your equity has to go into the new property. If you pull any equity out during the transaction, it is taxable. They do not prorate your cost basis. They do not offset that anyway through the 1031 exchange. If you have something else on your tax return, net operating loss, carry forward, suspended passive activity losses, etc., you might be okay. You might be able to pull cash out and not pay tax. But if you don't have any of those and you pull cash out, it will be taxable. It will be 100% taxable. Second area, you see a lot of things out there on the internet and brochures, and it will say things like you have to trade equal up in value. You have to replace your equity. You have to replace your debt. That's not entirely true on a couple different levels. So first one in this slide, we're talking about replacing debt. Well, in that example, we sold for $1 million. We've got $400,000 of equity, $600,000 of debt. If we move across the board through a 1031 exchange, let's just say we bought an asset worth $1 million. We reinvested the $400,000 of equity. So the difference is now the loan that was paid off on the sale. We've got a $600,000 missing component. That can be new debt. So we take out a new loan on the purchase of $600,000. It could be out-of-pocket cash. We could buy that $1 million property and pay all cash for it. Effectively, we have replaced debt with cash. That works. As long as we've bought property worth, say, $950 or greater, we've reinvested that $400,000 of equity, and we either get a new loan or new equity, we've satisfied all the requirements and it's tax deferred. You could always add cash to a transaction, but if you pull cash out of the transaction, it's probably going to be taxable. One of the areas in Hawaii, especially on the Big Island, is you've got fog. So we always kind of make fun of the comparisons. In London, you've got the fog, the famous fog. In Los Angeles, I was born and raised in Los Angeles, so I have to throw this out there. You've got the smog. On the Big Island, you've got fog, which is the volcanic emissions. And that, in a lot of cases, has to be disclosed. So this is just a kind of a warning. We've had Hawaiian Island transactions fall out because the buyer wasn't disclosed there was fog problem. And then the buyer found out about it and left. So be careful if you're selling on the Big Island, you probably want to look at VOG disclosures and see if that's needed. Okay, next one kind of goes back to how much do you have to reinvest. This is a partial 1031 exchange. A lot of stuff out there makes it sound like you cannot trade down, you cannot pull cash out, you can't do a partial exchange. That's not true. You can certainly do a partial exchange, but you're going to pay taxes, or probably going to pay taxes. You may have something on your tax return that offsets it, but so when people say you have to trade equal up in value, you have to reinvest your cash, you have to replace your debt, they're saying that because that's usually what you have to do to defer all your taxes. But there are all sorts of reasons why people trade down on purpose, and they just know they're going to pay some tax. Or they're, real estate investors are often real estate rich, cash poor, so they may sell and maybe they pull out $50,000 or $100,000 of cash to create a cash position. It's always possible. You could certainly do it. It does not hurt the 1031 exchange transaction, but it will be taxable unless you've got something else to offset that. So just keep that in mind. It's possible. People do it for strategic reasons all the time, but you have to be aware of what the tax consequences are going to be. Last slide, and then we'll open it up to questions. So this is one of my favorite slides because there's a lot of planning opportunities here. And that is combining a 1031 exchange with a 121 exclusion. And again, I see lots of stuff out there that say you cannot do a 1031 exchange on a primary residence. And as we talked, that's pretty much true for the most part. But it's possible. You can plan to do that. You just have to work on it a little time. So I'm going to use a specific example. We had a client who bought property in La Jolla, California, lived there for 42 years as a primary residence, husband and wife. At 42 years, they were having medical problems, wanted to go back east with their family, etc. But if they sold, they had an $8 million gain. So because they've lived there for way over 2 out of the last 5 years, they would get $500,000 tax-free. But they pay tax on $7.5 million. That'd be painful. That would push them right into the top tax bracket for both federal and state. So with that, we said, look, there's an IRS ruling out that allows you to convert the property to investment property. So in their case, we recommended move out of the property, convert it to investment property. I recommended they rent it for 2 years. That straddles 3 tax years. Very good proof that they intended to convert it. And then after that 2-year holding period, after they rented it for that period of time, sell it. So they did that. Now, at the time they sell, they still qualify for the 2 out of the last 5 years. So they got $500,000 tax-free, and they can now say we've rented the property for a full 2 years. So now we qualify as rental property. So they could also do a 1031 exchange transaction. So they actually got $500,000 tax-free, $7.5 million tax deferred through a 1031 exchange. They paid no taxes and got back east with their family. So there are ways to combine a 121 exclusion, a 1031 exchange, converting primary to rental, converting rental to primary. That gets complicated. You got to get your tax advisor involved there to make sure you qualify. If it's investment property first and then a primary residence, your 121 exclusion is going to be prorated. So make sure you understand exactly how that works before you get into that. In other cases, you may be selling or buying multiple properties, and it might be tough to get all the sales to close first or all the purchases to close first. So you may have to combine some 1031 exchanges. It's possible to start off with a forward 1031 exchange and then go into a reverse 1031 exchange. It's possible to start off with a reverse and go into a forward exchange. It's possible to do a reverse improvement exchange and things like that. So there's all sorts of strategic advanced planning, if you will, when you have a lot of properties involved and you're trying to solve for a very specific problem. So with those, just kind of give us a call. We can kind of walk through the process. and help solve the problem, whatever that is. We try to be problem solvers. We try to be more consultative and advisory in nature. And that was a quick whirlwind tour on 1031 exchanges. This is our contact information for our Honolulu office for those who have questions. Mahalo for attending our webinar today. And I got most of the questions as I was going through the program. Tom, I love the comment, VOG, I learned something new. Yep, when I learned about VOG the first time, I was kind of like, what are you talking about? But you do learn something new every day, that is for sure. We have a question on fees, so let me answer the question on fees real quick. It depends on the type of exchange. So I'm going to answer this question kind of both specific to us as Exeter 1031 exchange and also industry-wide, so that we can kind of see the variances. With a forward 1031 exchange, which by far is the most common, today most of the fees for one sale and one purchase are going to be somewhere in the probably $1,200 to $1,500 range, sometimes as high as $1,800. So that's the most common. Some of the smaller exchange companies, especially the real small exchange companies, they're still maybe $1,000, $1,100, something like that. Be careful. You want to make sure that your exchange company's got the regulatory oversight. That's not cheap. You want to make sure they've got the bonding, insurance, and all of that. That's not cheap. You want to make sure they're going to stay around a long time. During the 2008 recession, we had calls all the time for a couple of years where they said the exchange company I used went out of business. How do I get copies of my documents? You don't. I mean, they're not regulated. They're not required to hold the documents. So if they go out of business, they're out of business. Unless you can track them down, that's a problem. So you want to make sure the fee's enough where the company's going to be around a long time, no matter what happens. When you get into reverse exchanges, those get a lot more complicated, of course. There's a lot more moving parts. I would say the average fee it's a bigger range. It's probably $6,000 to $12,000, give or take. Again, there's some cheaper than that. Be very careful. Companies take they just kind of sidestep issues, take shortcuts, whatever. You have to be careful. If it's a reverse exchange with all cash, for us, we're $7,850. If there's a lender involved, we're $8,850. Then you get into improvement exchanges and combinations. Those are probably, say, $9,000 to $12,000. You get into really complicated stuff, so it goes up from there. But most exchanges are probably forward exchanges, and they're probably in that $1,200 to maybe $1,800 range. We are $1,295. That gives you kind of an idea there on fees. And I got all the other questions during the presentation. If there's any others, go ahead and ask. If not, then we will wrap it up. I'll wait a minute or so to see if there's any further questions. While we're waiting just to reemphasize, we are more consultative advisory. So if you want to call, brainstorm with us, happy to do that. Give us a call. You got the phone number there for our Honolulu office, and we could certainly walk you through the process, answer any questions you might have. These used to be very simple. They're now very complicated. So that's our job, is to kind of work with you and your advisors and walk through the whole process. So all good there. We've got a question on how often you see exchanges for eligible U.S. territories. I believe the only ineligible is Puerto Rico and American Samoa. And you're absolutely right. Those are the two that are not going to be considered like-kind property. It's not a huge amount. We probably do 1 to 3 at the most per month. So it's a smaller transaction volume. And then when you go into like the foreign property transactions, our volume could be anywhere from 1 to 5 a month. So not a huge amount of our business, but a lot more than it used to be. 10 years ago, we do 1 or 2 a year. Now we're doing 1 to 5 a month. So it's become a lot more common. There's also a follow-up question on the foreign property about, I'll paraphrase. It's really on foreign currency. So in most 1031 exchanges, the sale property closes, funds are wired to the qualified intermediary. They're either wired in US dollars or they wire and then convert to US dollars, because that's how they make their money. They invest the funds and earn interest off the funds. But what it also does on foreign property transactions is put the client at risk, because the foreign currency fluctuation can be significant. So we're set up to actually receive and hold, and I think it's 54 different foreign currencies at this point. So we actually do not convert to US dollars unless you tell us to for different reasons. So in almost those 54 cases, we will actually receive and hold in the foreign currency, and then we'll wire out in the same foreign currency. Or if you're buying in a different foreign country, you tell us what to convert to and when to convert, and then we'll take care of that for you so we can wire out in whatever currency is needed. We've done foreign property exchanges now in about 45 different countries, so it's always a new experience when it's a new country. And it looks like that's all the questions at this point. Again, you've got the phone number, you got our website address. You can also email us at ask@exeterco.com. So the same exact website there, just put ask at in front of that and email whatever questions you might have, and we'd be happy to respond. Usually we respond within 24 hours of whatever your question is. So again, mahalo. Thank you for attending the webinar today. We very much appreciate it, and we look forward to working with you in the future. Take care.